Welcome to China Gateway 360, connecting global businesses with China through insights, opportunities, and trends. Right now, the People's Bank of China is making a massive shift. They're moving away from the loan prime rate as their singular benchmark. If you're a foreign company borrowing renminbi, this is a real game changer. It basically rewrites exactly how your next loan is going to be priced. So, we're looking at a situation that requires some urgent strategic moves on your end.
What we're looking at here is a pivot to a market-driven, overnight-anchored framework. In plain English, borrowing costs are going to react a whole lot faster to liquidity changes. And considering that 90% of new loans are still tied to the old rate, getting a fresh pair of eyes on your treasury contracts right now is absolutely critical.
So what kicked this all off? The catalyst was the Q2 monetary policy report. The PBOC officially crossed out their old goal of reforming the LPR, and instead they're pushing for diversified benchmarks. We're seeing a much heavier focus on overnight rates now.
When you compare the two systems, the contrast is pretty stark. The legacy LPR system relied on these delayed monthly administrative updates. It was slow. But the new framework, anchored by the DR01 overnight rate, it operates on immediate, market-driven daily updates. It's really night and day. Now, you might be wondering how this actually hits your bottom line. Well, PBOC policy now directly drives the DR001, the overnight rate. That instantly changes bank funding costs, and those changes pass straight through to corporate borrowers. It completely cuts out those old administrative delays. The macro rationale behind all of this is actually quite straightforward. Basically, weak credit demand was blunting the effect of traditional rate cuts. By anchoring things to overnight rates instead, the PBOC makes sure that any policy changes they make hit the real economy much faster.
China Gateway. Gateway.
Your gateway to business in China.
Of course, the impact across your specific portfolio is going to vary. If you've got short-term trade finance, that's going to react almost instantly to any liquidity changes. On the flip side, your multi-year fixed-rate loans, those will stay stable until it's time for renewal. We also need to talk about the currency angle here, which is vital. Consistently cheap overnight renminbi actually flips the economics a bit. It makes direct local borrowing significantly more attractive than borrowing US dollars and dealing with a cross-currency swap, especially once you factor in those hedging costs. Looking ahead, rates will likely stay low under the PBOC's moderately loose stance. But here's the catch. Forecasting your future financing costs now means you have to actively model DR0001 volatility. You can't just wait around for the 20th of the month anymore. When it comes to transition risk, it all comes down to one crucial number, 90%. Because over 90% of new Chinese bank loans are still tied to that legacy LPR, foreign borrowers really need to brace themselves for a massive, widespread contract repricing event. So let's get into a fast action playbook for your treasury team. Step 1, you've got to audit those loan clauses immediately. Talk to your bank and confirm exactly which benchmark is driving your next repricing date. No surprises here. Moving on to step 2, it's time to hedge any intolerable floating exposure. You want to capitalize on the current loose liquidity and lock in those low absolute rates using fixed structures. You'll want to do this before market volatility starts to pick up under the new regime. Step 3, you need to monitor the DR001 in real time. Seriously, a sustained spike in this overnight rate is now your absolute earliest warning sign of monetary tightening. You'll want to build this tracking directly into your daily dashboards. And finally, step 4, optimize your cash pooling. We're moving away from the old way of just leaving surplus RMB sitting idle. The new way is to actively sweep that cash into short-term money market instruments. That's exactly how you capture those higher yields driven by these overnight rates. To quickly wrap things up, the PBOC's pivot to a fast market-driven framework is already underway. The big question is, are your treasury systems actually prepared to manage a daily moving target? That's all for this China Gateway 360. Like and comment to receive materials from us. Thanks for watching, and we'll see you next time.